Listen-only mode.
Good afternoon, ladies and gentlemen. Welcome to today's webinar, Is There an ETF Bubble? Before we kick off, if we could please just show our hands in the electronic hand raising functionality to see if you can hear me. I see you've got one hand, a couple hands coming up. We are looking good. We've got almost all the hands up. I'll give it another minute or so just to make sure that everyone is can hear. And if there are any issues, please just drop us a question in the question category. Okay, I think we've got enough hands up. So we're going to kick this off. Before I do so, I'd just like to thank the Standard Bank online team for inviting you and for hosting us at today's webinar. My name is Chris Rule and I represent the CoreShares business. CoreShares is a passive asset manager who provides exchange-traded funds, unit trusts, and other asset management services to the market. So we've got an interesting topic today. We're going to be chatting about, is there an ETF bubble? But before we do so, we wanted to break it down into its various aspects. And so we wanted to, first of all, just do a very high-level overview of, is there an ETF? Or what is an ETF? What is a financial bubble? Is there an ETF bubble? And could there be a passive bubble? So before I kick off, I just want to let everyone know that if you've got questions, please ask them in the bar on the side. We'll probably take most of the questions at the end of the webinar, but if there's a question that's relevant to a point in time in the webinar, then we will take it then. So I don't want to take up too much of your time, but what is an ETF? I think it's an important concept to understand exactly what an ETF is before we understand what is an ETF bubble and is there an ETF bubble. There have been, I wouldn't say many, but there have been quite a few queries around whether there's an ETF bubble, and there are a few articles circulating theorizing of whether there could be an ETF bubble or not. So what is an ETF? An ETF is a registered collective investment scheme portfolio that tracks an index. That's as simple as it is. Let me break that down though. So a collective investment scheme is effectively a unit trust. An ETF is a unit trust, and it's a unit trust whose units trade on the JSE or any exchange, but in our instance, they trade on the JSE. So the acronym ETF, Exchange Traded Fund, tells you a lot about the actual instrument. So they can be bought and sold on an exchange like a share. They are traded. So in other words, you can buy and sell them throughout the day. And of course, it's a fund. The structure of the portfolio is a unit trust fund. So you buying one exchange traded fund or one ETF, you effectively get access to a number of securities which make up that fund or that exchange traded fund. So that's at a very high level what an ETF is. And to give you a quick illustration, this is how an ETF really works. So let's take our S&P 500 fund, for example. You would come along to us as CoreShares, you would make an investment, and what we do is we take that money and then we literally go and buy those underlying shares. So S&P 500, you can see you're on the JSE standing down there, that little man on the bottom right, and there's Joburg. And we take that cash, we literally go and buy US dollars, we move our money into an offshore brokerage account or custody account, and we literally go and buy those underlying shares. So we hold Facebook, Amazon, Microsoft, etc., in the instance of the S&P 500. And that's that basket of shares or that fund structure, but effectively you're able to buy a basket of shares which make up the underlying. And fund is important because it's different to a note. A note you're taking on credit risk, or you're taking on the risk that the issuer, CoreShares, may default and not pay the returns of the S&P 500. But in a fund environment, even if CoreShares were to go bankrupt, your money would be safe because it's in a ring-fenced fund scenario. So the beauty of ETFs is that they're transparent. You know exactly what your underlying holdings are. In fact, if you're a large enough investor, you can come to CoreShares and you can say, please, can you send me, instead of cash, when I sell, send me all those underlying shares and we will oblige and we will deliver you the underlying shares. They're liquid and flexible. They trade on the secondary market, but their primary point of liquidity is actually in the primary market. And we'll touch on some of that, the detail a bit later. They're diverse, of course. They're highly regulated, so FSB and JSE regulated, because they're both collective investment schemes and securities which trade on the JSE. They're regulated by both, and of course they're cost effective. So that's what an ETF is. Now I think this is fundamental, the ETF understanding, to the understanding of whether there is an ETF bubble or not. But before we carry on, let's break down the question of, is there an ETF bubble, into its second component, and what is a bubble? What's a financial bubble? So a financial bubble is effectively an instance where a financial asset rises to levels where it's either above its historical norm or it's above its intrinsic value. And generally the valuation is driven there based on hype or based on structuring like derivatives, or some driver that doesn't relate to the fundamental or the intrinsic value of that asset. And eventually what happens is there's a systematic event that causes the crash or a burst in the bubble. So if we look at asset bubbles through history, these are some examples of classic asset bubbles. The Dutch tulip bubble, or tulip mania, is a classic example where the valuation of tulips were forced up or driven up to such a far extent that eventually the value of one tulip was about equivalent to the value of a home in Amsterdam. So you can see there's a massive overvaluation of that asset, and eventually that bubble burst for a number of reasons. There were in fact, even in the 1600s, futures contracts on tulips, which helped drive up the prices. And then with the inclusion of the plague, meant that people could no longer trade them, so the valuations dropped right out. South Sea bubble is a classic example. South Sea bubble was effectively an instance where the South Sea trading company was given an exclusive right to access America as we know it now. And given the great success of the East India Company, people piled into the share without seeing any actual results. So people bought that share up from like 128 pounds. Now we're talking about the 1700s, to 1,000 pounds a share, based on stories that sailors were talking about extensive riches, but without actually seeing a fundamental valuation. And so eventually, when the reality came home to roost, that bubble burst. We know, of course, very well of the dot-com bubble, where there was an absolute massive wave of tech companies coming to the market and listing at valuations that were far beyond their intrinsic value. And there was such a manic rush for people to buy tech companies, because it was the next big thing, that people ignored any fundamentals, and there was a massive crash based on the realization that, you know, a lot of these companies didn't have any value add. And then the housing bubble, which is very close in our history. So this was a bubble based, again, there was no fundamental reason why people should be able to, subprime lenders should be able to access debt and therefore buy houses and continue to drive housing prices up. And eventually, when the chickens came home to roost, and people realized that these collateralized debt obligations and these mortgage-backed securities had very poor credit quality, the banks stopped lending, people stopped being able to buy houses and drive pricing up, and then we saw the massive housing bubble in the US. So all of these have a very similar trend, in that prices or asset prices are somehow driven well beyond their value, and they're driven there either by a psychological or behavioral bias, or by a structural bias, like in the US in the housing bubble, where we had the introduction of CDOs and mortgage-backed securities, and effectively structuring, which was driving up valuations. So that's really, if we break it down, we've got financial bubble on the one side, where an asset is driven well beyond its valuation, and then eventually bursts. And then we've got an ETF, which is effectively a structure which you can access a number of underlying assets through. So the question is there an ETF bubble? And the real question is, how could there be an ETF bubble? ETF, or are ETFs an asset class? Asset classes are defined as a group of assets that behave in similar ways. And an asset class would share a very similar risk and return characteristics. So if we go back to our example of bubbles, we've got tulips. Let's call them an asset. Now, you might buy different kinds of tulips, but they all have very similar characteristics. If we look more recently and we look at how we would define asset classes traditionally, we've got cash as an asset class, we've got bonds, we've got listed property, and we've got equities. Now, what you'll notice is we don't have ETFs in any of these specific asset classes. ETFs are actually not an asset class. So what is an ETF? An ETF is simply a product wrap. So what an ETF does is it gives you exposure to those asset classes. So let's look at one of our classic bubble scenarios, like the tulip bubble, where was there a tulip pricing increase? In this instance, let's say you could buy an ETF future. There could still be at least a tulip ETF. There could be a tulip crisis that impacts tulip ETFs, but there's not an ETF bubble. So the bubble is specific to the asset class because an ETF is simply a product wrap or an asset class wrap. So ETFs give you exposure to the asset class rather than driving the valuations of those asset classes themselves. And of course, they're buying the physical underlying. So an ETF is not a derivative structure. There's no derivative overlay. Certainly in the South African market, there's no derivative overlay in ETFs. So is there an ETF bubble? Well, we would say no, there's not an ETF bubble. Because of the fact that an ETF is simply an access to an asset class, and the fact that for a bubble to happen, you need an asset class valuation to drive up significantly. So let's look at this and say, is there an equity bubble? Possibly. Will the ETFs that buy equity strategies be exposed to that bubble scenario? Yes, they would. But then so would all shares that you buy, or equity shares. So would unit trusts. It's simply a product wrap. So it's not any different to any other investment which would give you exposure to that asset class in a bubble scenario. So we would like to debunk that myth and say, no, there is no ETF bubble. Certainly in South Africa, there is no reason to believe that ETFs in themselves would create a bubble scenario. So let's debunk that, and let's say that if there were a bubble scenario and you had bought, let's say, a top 40 fund or a top 50 fund through an ETF or through a unit trust, or you went and bought the underlying shares yourself, you would have the same experience in the market downturn. So the real question then, perhaps where there's some confusion, is there a passive bubble? And is there a passive bubble in South Africa? Now, if we think the reasoning behind questioning why would there be a passive bubble is because passive managers have to go and buy an index, and they do so in inverted commas blindly, where they're simply buying shares because they're in the index and not because they're of maybe a good valuation or a reasonable valuation. Could there be a scenario where passive investing drives valuations of underlying asset classes into bubble territory? And I think that's where there's some confusion between an ETF bubble or a passive bubble. So are shares being driven well beyond their value because businesses like core shares and so on simply go and buy shares based on their index inclusion? And first of all, this is the most obvious rebuttal to this, and it's the fact that passive represents a very small percentage of our market in South Africa. So you'll see there that less than 1.4% or less than 1.5% of our total unit trust or collective investment scheme market is represented by passive. So the the first, is there a passive bubble in South Africa where passive participants could be driving prices well beyond their fair value? Well, not based on this market share. If passive was, let's say, north of 70% of market share, and everyone was tracking one index, everyone was tracking the top 40, then yes, there's potential for a bubble scenario where passive managers are driving prices up. But at the moment, because passive is such a small part of the South African market, it would be foolish to assume that they could therefore influence pricing to such an extent that it would push it into bubble territory. And the second is that ETFs or passive is as liquid as their underlying, just like a unit trust is. So in other words, if everyone were to sell all of their passive holdings from let's say the top 40 in one day, the ETF liquidity would be as liquid as the underlying. So that means that some 16.3 billion rands worth of underlying could be liquidated within a day. Now that assumes 100% of market share, but it's a big number. And what's important to know is that unit trusts go and buy all those same assets, so they would be impacted in exactly the same way. So we've got a relatively liquid underlying, we've got a very small market share. Could there be a passive bubble in South Africa? No, we don't believe there could, based on the very small market share of passive at present and the fact that we have a liquid underlying. The second important consideration is that these passive bubble scenarios all assume that passive tracks only one index. So 1.43% of this market is passive. Now, if we look at cap weighted, so market cap weighted is what we probably most usually think of as like top 40. We'd maybe think of it as all share. Maybe you think of it as Swix 40. Maybe you think of it as Swix capped. Maybe you think of it as top 40 capped or top 50, like in the case of the core share top 50 ETF. My point is that each of these indices are actually different and they're constructed in a different way. We did some quick research, and what it showed is that the 5 big passive providers in their market cap weighted indices actually use different methodologies for each of them. So in other words, when they go and buy assets, they're not all doing the same thing, which is the common critique of passive. As I mentioned, some would be having a Swix 40 mandate with a 6% capping. Others would have a all-share mandate uncapped. And so you're picking up very different share exposures when you're actually buying those underlyings. Another very important consideration, and certainly if you look at the core shares products, a lot of our products and a lot of passive, the way passive is moving is into a smart beta environment, where you aren't simply buying shares as a function of how large they are in the market or how large they are as a percentage of the total index. So there are 3 reasons why we don't believe there is a passive bubble. That is because the passive market share is so small in South Africa that it couldn't possibly influence asset pricing to the extent of bubble territory. The second is that not all indexes are the same. The assumption that all passive managers go out and buy the same shares in the same weight is quite simply incorrect. And what we see is a lot of, frankly, propaganda. And then, of course, that ETFs at the end of the day are as liquid as their underlying. So, yes, we can trade in the secondary market, and market maker will be there to take up a limited volume. So for retail investors, for most online share trading investors, it's not an issue. Yesterday, we did 7 million rands worth of trade in our S&P 500 fund. So, you know, that liquidity is there. We could have done double that, triple that in the secondary market. In the primary market, we're as liquid as the underlying, so there's a lot of liquidity there. And generally, you know, we think that those 3 reasons debunk. The first is there an ETF bubble? No, ETFs are not an asset class, so there's not an ETF bubble. Then are ETFs as passive instruments pushing prices to bubble territory? Well, quite simply no, because they don't represent enough of the market. And, you know, the interesting thing is, if ETFs or passive represented 80% of our South African market, then we would be potentially entering into bubble territory where passive investors buying simply based on a rules-based environment would be influencing pricing. but then you have to consider that not all passive managers are tracking the same index. So we think that a lot of the bubble asset pricing, passive bubble stories are quite frankly not well founded and not well considered when acquisitions are made. Are there asset bubbles in the market? There potentially are, but remember that passive and that ETF simply gives you access to those asset bubbles or those asset markets. So that wraps up our relatively brief 20-minute webinar. We usually allow for 15-20 minutes of questions. If you have any questions, ETF related or related to the webinar or anything passive or investing, we'll do our best to answer them. So please pop a question into the chat bubble or into the question bubble, and we have to take your questions. If that's it for you, I'm not seeing any questions at the moment. But if you've tuned in for today, thank you for joining us, and thank you to the Standard Bank Online guys. I'll sit around for about 5 minutes just to see if there are any questions or if you want to think of any questions. But thanks very much for joining us, and thanks to Lindsay and the Standard Bank Online team for inviting and for hosting us on today's webinar. I'm not seeing many questions. We've got a few thank yous, so thank you very much. I'm still not seeing any questions. Lindsay, if you see any questions on your side, we may be having a technical.
Yes, I don't see anything on our side. Just the thank yous that's come through.
Okay. So as I said, I will hang around for 5 minutes or so. If you think of any questions, here we go. We do have a question. Please elaborate on where there might be a price bubble. Question coming on. I'm not entirely sure what you mean. Pricing bubbles are usually very difficult to predict. That's the problem with bubbles in economies. As far as we've seen, there are a few market participants calling a US market bubble, but there's no real. I certainly haven't seen any conclusive evidence to support it. Our markets have had a very good run over the last 10 years. We mustn't forget that. Post-global financial crisis, markets have really done well. People have been calling the markets to have run too far for 5 years now, and they've missed out on a lot of returns. Look, pricing bubbles are anomalies that will certainly happen throughout history. What we at CoreShares like to talk about is the consistency of making investments, and rather spending time in the market than trying to time the market specifically. What tends to happen is that people pull out of the market too early and enter the market too late. And so even an investor who's trying to time the market and maybe misses a bubble may have worse return than someone who simply rode through the bubble, like a global financial crisis, which we saw quite recently in our history. But we have had fantastic equity market returns. The world is a different place. We've got quantitative easing still playing out. We've got an extremely low interest rate environment. All of these kind of factors need to be considered. But we would say stick to a long-term plan, make an investment, and stick with it. So in terms of elaborating on where there might be a price bubble, I think that's anyone's guess, to be honest. If you'd like to follow up on that explanation, please feel free. The question that we were picking up a lot, and certainly the Standard Bank Online guys was are ETFs in bubble territory because they've become popular? And that's really what we wanted to tackle today, to give you comfort that the ETF structure itself is not a bubble, that it's simply exposure to an asset class. I'm going to keep scrolling. I don't see any more questions. So I think we'll wrap it up there for the day. Thank you very much, guys, for tuning in. Thank you, Lindsay, for hosting us. And I trust you'll have a good day. And if you have any questions, please drop us an email at info@coreshares.coza. Or if Lindsay wants to give the Standard Bank online details, please do so. You can reach out to the Standard Bank team.
Thanks, Chris. The email address is securities@standardbank.co.za, which you'd also find on our website.
All right, thanks. That's a wrap from us.
Thanks, Chris.
Thank you very much.
Goodbye.
All right.